Hi there, welcome to our YouTube channel. You're with me, CJ Terra, and this is Source Forex Academy. So, on today's topic, we're going to discuss on did you know that trading with a small account can be very challenging, and what are the ways and means you can utilize your account so that you don't make losses or you don't blow your small account. We're going to go through a couple of things in this video. Make sure you watch it to the end. Leave a like, leave a subscribe if you like this video, and if you like such content for us to post more, we really need your support. Other than that, let's get into the video. So welcome to the charts. So there are basically always three things that you are either doing wrong in terms of why you find it very hard to trade with a small account. So the first thing that we're going to talk about is what we call time frames. Okay, so once you understand how time frames work, you need to know to say every time frame that the amount that you have in your account determines which time frame you're supposed to take a trade on. Okay, time frame. That is the first thing. How does this affect your account size? So let's say, for example, in this scenario, okay, we're looking for the market is making higher highs, higher lows, as you can see. Okay, the market is in an uptrend. Higher high, higher low, higher high, higher low, higher high, higher low. Somewhere there. This is a new higher high. Okay, so now we know that this market is in a bullish uptrend. Okay, so the next thing probably that it might do is to make a new higher low here. Okay, so now we understand that as a concept. Initially we are buy bias. We don't know how far this bullish momentum is gonna go. If we zoom out, yes, there are levels here to the left of our chart that possibly the market is targeting before it drops down. Okay, so we're looking forward either for the market to touch down in these areas above here, so meaning we're still buy bias. Now, does that mean initially we're gonna buy right here? No, the time frame is too high, because one, if let's say you set a buy here and you have a $50 account or $100 account, you set a buy here, it's not realistic. Your stop loss, if let's say you want to put it below the zone somewhere there, this zone here, okay, this zone here, because you believe, okay, the market, if it's gonna reverse, it's gonna reverse down in this zone and do a continuation to the upside, and you take profit somewhere there or even higher above. This stop loss from here to here, that's a lot of money. Okay, because why? We are on a daily time frame. So now, because we understand that we have a smaller time frame, we have to go down to a lower time frame to reanalyze what the market is doing on the lower time frame, so that we can have our entry opportunities. Okay, so as you can see, this is a 4-hour time frame. The 4-hour is also pushing bullish. We have zones that it has created. Okay, there's a zone here that the market failed to break above. There's another zone somewhere there. Okay, let me just remove this. Yeah, okay, so now we are telling a story. We can't enter here again with a $50 account, because if we enter here, let's say we set a buy here, our stop loss will be somewhere below the zones, take profit somewhere here. From here to here, this is a 4-hour time frame, is still a lot of money, in as much as you are using a small lot size. Okay, so you have to go down to a time frame further. Okay, because now you're looking for a perfect entry that allows you to have a minimal stop loss. Okay, so as you can see, the market is pushing bullish. It broke out of this zone. We're expecting for that drop below. We can even still go further to as low as the 15-minute time frame. Okay, but if you've noticed what we're doing, we're coming from a higher time frame, analyzing what the market is doing and seeing what it is giving us. As you can see, the market is pushing bullish here. Okay, you can see we have something like that. Market was respecting this. Okay, it has just broken out of this channel and moved all the way to the upside. So we had something like this here. Okay, the market was creating this, broke out, retested it, and now it's pushing bullish. So there's that possibility of it coming below. If we were to buy in here this zone, if the market comes down to this zone, and look at where our TP initially would be compared to where we started from on the daily time frame, our TP will be somewhere there, our stop loss will be there. From here to here, that's, you're risking less. Okay, so you have to understand the time frame that works best for you when it comes to your money that you have in your account. That determines a lot. Okay, the second thing that you have to look at is lot sizes. Okay, so lot size. Why is this information important? Because a lot size determines how much volume you're gonna buy or sell, okay, of whatever given instrument that you're buying or selling. So now let's say, for example, for argument's sake, right, we buy using a 0.01 here, okay, and our stop loss is giving us $1 in negative if we put a stop loss here. So now if we're increasing the lot size, that means we're increasing the amount that we're risking again. So let's say we have entered 10 trades, backward trading, we've entered a lot of trades. Now we're risking $10 out of the initial amount that we have. We enter 10 more trades, now we're risking $20. So understanding your lot size is very important, in that it will guide you on how exactly you are trading and how much you're risking. Because after the lot size, you have to consider what we call risk management. Okay, risk management comes in a way that, let's write it down. So lot size, we'll discuss more in the next video about lot size, because I need to educate people on which lot size is favorable. Risk management. So there are a lot that comes with risk management. Most people feel like, okay, I'm risking $10 to make 20, that's risk management. No, that is risk management, but there's other things as well. There are issues of what instrument are you trading. Is it something that is very volatile? Let's say, for example, in the volatility world, there are instruments like VIX 100, VIX 75. These are volatile instruments, in that when you take 100, even if with the small lot size, you find that just one single movement, already you are in huge drawdown. So understanding which pairs to trade is part of risk management as well. You need to really understand, how is this pair moving? If I use this small lot size, how much money am I risking in just this small move from here to here? Is it something that I need to trade? If it's very volatile and your account size is small, stay away from it. There are other instruments like VIX 75 1S. Those are friendly. Even in the world of currencies, there are instruments like Nasdaq, US 30, gold. Those are very volatile instruments, in that just one candlestick can take you out. Okay, so you really need to consider exactly what you are doing. You have to understand, is favorable, what pair is favorable with the amount that I have in my account. You don't have to trade everything. It's dependent on your account size. The other aspect of risk management is, how much are you risking and how much are you gaining? Because if you're looking at risk management of 1:1, meaning if you're risking $10, you want to make another $10. Then there's 1:2, where if you're risking $10, you want to make $20. You always have to aim for either 1:2 or 1:3. Why is that? Because each trade that you take, it's not every trade that you're gonna win. So now, in a situation where you're risking 1:1, you're risking $10 to make $10. If overall you take a total of 5 trades, right? You have taken a total of 5 trades and you have a $50 account. If you've taken 5 trades, you have blown your account. If you have lost all the 5 trades, or if you have lost 3 trades, you have lost a total of $30 and now you are down to $20. So now imagine a situation where you're risking 1:2, risking $10 to make a 20. Even if you lose about 3 trades and win only 2, you'll still be in profit that day. Okay, because you would have made a $40 in the first 2 trades and lost a 30. Now you're still up by the end of the day by $10. So risk management you have to take into consideration. Every time you're taking trade, understand what is it that I'm doing, how much am I risking, how much am I willing to earn. Okay, all that information is important, guys. This is a business. This is not a joke that you just sit around and just take trades just because you feel like. Everything you have to, it has to be a calculated move. That is the only way you're gonna see the profits that you're looking for. Okay, otherwise, always remember, a peep a day keeps poverty away. Subscribe to the channel for more videos like this. Leave a like, leave a comment. Let's interact.